Hi, I'm Professor Crawford Spence. I'm Professor of Accounting at King's College London, where I study financial markets and financial professions. I want to recommend some top reads for you that will show you why accounting and finance is such an exciting subject to study generally and also specifically right now. In the last few months, COVID-19 has changed lots of things, and it has had major impact on some long-standing discussions within finance and accountancy. So there's never really been a more interesting time in lots of ways to study financial markets. So what I've done here is picked out a few key articles that illustrate just some of the ways in which financial markets and financial professions have been impacted by COVID-19. So this first article here takes a look at Stockpickers failing to take a big chance in the recent market rout. Now what that's looking at is this long-standing debate over whether investors should be giving their money to active fund managers, which is groups of individuals who apply their own expertise and pick and select stocks, often for quite high management fees, but they promise higher returns as well, or should they be giving their money to passive investment vehicles, passive funds, which track a stock market index and don't try and make individual stock picking decisions. And they tend to be much cheaper for investors, although the promises of returns are not necessarily as high. That being said, research shows that passive investment has been very beneficial for lots of investors over the last sort of 10 years or so, and it's very much a growing area. More and more money is moving to the passive investment space. So a lot has been said about active stock pickers will prove their worth, they justify those high management fees, particularly in volatile markets, where it's argued that they can move against current market trends and pick winners and losers more easily, where passive funds just use robots and algorithms and computer programs to buy whole baskets of stocks at a time. Now, the recent crisis gives us a very interesting set of circumstances within which to test whether active versus passive funds are more effective. And according to this article, it suggests that actually even in economic downturns, passive investment vehicles are more interesting for investors, providing them more value. So this next article looks at the phenomenon of short selling. And in the financial crisis, we've had several regulators, including the UK regulator, which is generally considered to be fairly hands-off, banning the short selling of financial sector stocks. In today's COVID crisis, France banned short selling for 30 days, and so did many other European countries. And they've actually I think they extended those short selling bans, and then they've recently rescinded them to try and get liquidity flowing again through the market. Now, short selling is a curious activity. It's a way for traders to essentially bet on the price of a stock. It's, in all practical terms, it's betting on the stock price to go down for a particular company. But in practice, they don't actually buy the stocks. They borrow the stocks from someone else and sell those other people's stocks, and on the hope that the price will go down, say in a week or a month from now, and then they buy those stocks back at a cheaper price and give those stocks back to the people who originally loaned them to them, and then they sort of bank the difference, maybe pay a small fee to those who loaned them the stocks in the first place. There's lots of reasons they may want to do this, but some regulators are worried that it's really bad for the companies whose share price may be pushed artificially low, and then stock markets spiral out of control to some extent. So it could give the company problems with raising or borrowing money to cover their costs, and if they're a bank, that could have consequences for the rest of the system that could exacerbate what we call systemic risk. So, I guess the question here is, are regulators right to ban short selling, or does such intervention stop the market from functioning in the way that it actually should? And that is an open question, really, but one that we find interesting to explore here at King's. This next article looks at bonds trading. Bonds are, one form of finance that companies can use to prop up their operations. Investing in stocks and equity is one form, and the other major form is debt, and that comes in the form mostly of bonds. And this article looks at how bond traders are turning to something that's mostly associated with equity traders, which is portfolio trading in volatile market conditions. So when markets are moving around a lot, traders need to respond quickly. This piece looks at why bond traders are now trading bonds as part of a basket of portfolios. So you can invest a partial amount in each bond as part of a sort of diversified portfolio, rather than just put all of your money into one or two bonds and throwing all your eggs into one basket, if you like. So this is something that wasn't so common in bond markets. But there are particular reasons why bonds are traded different to equities, and technology is something that is making these more sophisticated trading strategies much more possible. And with liquidity constraints that occur in crises such as the current one, traders look to ways in which they can try to generate more activity in the bonds that they're trying to trade. So this portfolio trading of bonds is one way in which they're trying to keep financial markets moving, in spite of the fact that people are very nervous about putting their money into specific areas. This next article looks at the group of financial professionals who are auditors and how they are using technology to cope with remote working. Now, traditionally, auditors, they verify the financial statements of their clients, who are companies, and they conduct checks, often being in the company's premises physically, checking inventory, checking financial records, checking that things that the company say exist actually exist, kind of like investigators in some sense. COVID-19 has changed that, because we obviously have social distancing practices in place, and it's not possible always for auditors to go and check whether there are particular items on a shelf of an organization's store or warehouse or whatever. So information needs to be gathered in a different way. So we see that some developments in this space, which were happening already before COVID-19, to do with artificial intelligence and big data and analytics, whereby auditors can access companies' financial statements remotely and analyze them using sophisticated software packages and artificial intelligence. And even in some instances, you've heard of big four audit firms using things like drones. So non-piloted aircraft, essentially, to fly over parking lots or coal fields to measure, to get some rough idea of whether or not piles of coal or inventory actually exist, or numbers of customers are similar to what the company is claiming. So this is all work that can be done remotely, not on the company's physical premises. And stuff that has been taking place before COVID-19, but has been definitely accelerated in the last 2 months since this crisis engulfed the rest of the world. So this raises wider questions, really, about the skills that auditors will need in the future. Are auditors going to increasingly need to be technically proficient? Yes. Does that mean that audit can be automated and you're not going to need fewer humans? Well, that's less clear. But what our research shows is that definitely in the future, you're going to see auditors are going to have to increasingly combine technological know-how and data science knowledge and expertise with traditional professional judgment and interpretation. So it's the combination of those different sort of hard and soft skills that are going to be very important for auditors in the future. And we see that playing out just now in the middle of the COVID crisis. This final article is also written from a sort of accountancy perspective, although it's relevant to both finance and accountancy. It looks at the financial earnings phenomenon of ebitdac, which probably needs deconstructed. That means earnings before interest, tax, depreciation, amortization, and coronavirus. A bit of a mouthful. The coronavirus element is obviously a new one, but EBITDA is, in simple terms, really a way of measuring a company's earnings before you make a number of accounting adjustments. Some people see EBITDA as a more fair and accurate representation of a company's actual earnings. Things like depreciation and interest and amortization, they vary less with the sales of the organization and more with say, accounting decisions that are made elsewhere. So EBITDA companies have often presented as something that is a fairer, more accurate representation of their actual ability to generate income. And with coronavirus coming, a number of organizations have now started to add the C onto the end of that. So they're basically adding on lost earnings as a result of coronavirus, saying, you know, instead of $1 billion we've made this year, you know, we would have made $1.2 billion if it wasn't for coronavirus, which is kind of curious because that information in some respects is not really useful. Because coronavirus has taken place, it's sort of hypothetical just to suggest that you would have made more money if it was not for coronavirus. So financial markets interpret that information with skepticism, as this article demonstrates, suggesting that, you know, companies should be talking about what their earnings actually are and what their future earnings potential is, rather than what their earnings might have been if it wasn't for this major event that took place. So you see the sort of shenanigans that companies try to engage in order to make themselves look better. And this ebitdac is one of those. So whenever you see ebitdac, you should probably be quite skeptical of the information that then follows on from that. So that was a flavour of different things that are affecting the accountancy and finance spheres. Particularly in the context of coronavirus. So we look forward to discussing these issues and many more issues as well with you at King's in the near future. Thank you very much.